Hi everyone, excited to be here today. We're going to bring together a small group of specialists across accounting, lending, property, and wealth planning to discuss the kind of proposed budget changes and what they could mean for our clients. There's been a lot of noise around trusts, CGT, negative gearing, ownership structures, and borrowing capacity. So the purpose of this conversation is to keep it short, to sharp, and not cover every technical detail, but give clients a practical, coordinated view of what matters, what not to overreact to, and where review may be needed. I'll do a quick run around for intros, and then we'll move into this, keeping it very sharp, because we all know you're very, very busy. So, quick intro. I'll hand to Tom first, if you want to intro yourself.
Yes, good morning, everybody. My name's Tom Howard. I'm an Associate Director at Pilot Partners. We're a full-service chartered accountants firm, and I'm lucky enough to be in the tax advisory division. So it's my team's pleasure to be up late on budget night, digesting all the changes. There's plenty in this budget. Obviously, as Matthew's alluded to, there's some significant changes here around trusts, negative gearing, and CGT. They are the real big three ticket items.
Great. Thanks, Tom. Jack, I'll pass to you.
Thanks, Matt. Yeah, Jack, partner at Medicos Finance, lending specialist to medical professionals, national business, and working with doctors, dentists, and vets to assist them with their personal lending, but also their commercial and practice finance as well.
Great. And Scott?
Yeah, hi everyone. Scott Guilford from the property team. We help our clients grow wealth using property investment. Been doing it for over 20 years and love what we do.
Perfect. And Joanne?
Yeah, g'day. My name's Jo Tonetti. I'm a senior financial advisor at Perpetual Private, part of, a national team that looks after advice for Medicos.
Perfect. Thank you. And I'm Matt. I'm the Chief Strategy Officer at Medicos Finance, and I'm excited to moderate today. So, Tom, let's start with you and the budget itself. Let's have a quick explainer of the things you've already touched on and what it might mean to our clients.
Yep. So, Matthew, as discussed, I mean, this is a major change from recent budgets. In the last few years, we've been talking to our clients and our referrers about there being not much by way of updates from the budget. This year, you can throw all that out the window because this is massive. It's massive for any business owner. But, you know, and today we're talking about Medicos especially. This is going to impact every single one of them. So, as I mentioned before, there's some massive changes announced here around CGT, around negative gearing, and around trusts. If I talk to the trust one first, because I really do think that this is the biggest item here. Australia has a love affair with trusts. We all know that. They provide flexibility, they provide asset protection, very good asset protection, some tax efficiencies, and opaqueness, to be quite honest. The budget is targeting these trusts, or the government is intent on targeting these trusts. Discretionary trusts are what I'm talking about. And we're going to impose a minimum tax rate if the legislation is passed, which this is just an announcement, by the way. We're yet to see legislation around this. They're looking to impose a minimum 30% tax rate on discretionary trusts. That will fundamentally change how discretionary trusts have been treated and used in Australia, and it will make a whole lot of distributions that are quite tax effective currently. That will make them completely ineffective after these changes are passed. And it's important to note that the changes around the trusts are not coming in until the 1st of July 2028, subject to the government being able to legislate them. They're making plenty of noise about it, but we're yet to see the legislation, and we may not see that for 6 to 12 months. The second change, the big change, is around negative gearing. And this has got plenty of press, but if you happen to have a negatively geared property prior to budget night, well, then that will be grandfathered. But going forward, the eligibility to be in the negative gearing system is much narrower. And so it is really restricted to new builds only. New residential premises is the wording, or the required investment. It's not impacting, however, negative gearing in different fields, for example, on share portfolios or on commercial property. Again, this is a proposed change that's yet to be legislated. There is draft legislation in front of the Parliament on the negative gearing change. But as always, there could be horse trading between now and when the legislation is finally passed. So some big changes around negative gearing. It's likely that the losses are going to be quarantined and have to be carried forward. So you can't offset your losses from property or residential property against your other forms of income as you used to be able to. For existing investments that are under the grandfathered scheme, you can still do that. But new investments, the real benefits of negative gearing, where you can offset the losses against other wage or investment income, is going to be tighter in the future. And the last one being CGT. Again, big changes here. We are changing or removing the capital gains tax 50% discount that we all know and love. It's nice and easy for everybody to use and understand. Well, that will be being phased out on the 1st of July 2027 if the proposed changes get legislated. And in place of it will be cost-based indexation, which is a fundamental change. It's a bit of a back to the future move because we did have indexation before the discount came about. But in some cases, people will be a lot worse off, for example, where they don't have much cost base at all. You can index nothing all you want, you're still going to end up with nothing. So very big changes here. What we're saying to our clients is let's wait and see how the legislation falls out. The time for panic is not now. There may be a time for panic in the future, but we at Pilot are across the changes. And so all of our partners and staff are across those changes, and we are talking to our clients regularly about them and how they might impact their groups.
Perfect. Thanks very much, Tom. So quick summary on that one, really important. It's proposed, not legislated yet. So don't freak out and wait and see to a certain extent before you kind of fire sale any assets and move
Absolutely.
from there. Great stuff. Jack, let's move to you and talk about how these changes are impacting lending. We know obviously lending is a big part of moving forward in their careers. Talk us through kind of how this is playing out in your world.
Yeah, look, and thanks, Tom. There's some really great insights there. I think to Tom's point as well, just around everything is kind of proposed at the moment. Certainly from a lending perspective, we're seeing some real world impacts immediately. So specifically with regards to what's flowing through to the bank serviceability models and around the treatment of negative gearing in relation to purchases of established residential stock. It's important to note these changes aren't uniform, so every lender is adjusting their policy differently and at different times. And so more than ever, for doctors looking to enter the property market and take lending out, particularly for established stock, lender selection and scenario modelling at this point in time is really critical. We've had a client just this week who came to us that had a pre-approval set up for an investment purchase prior to budget night. We've reworked those numbers and their borrowing capacity's dropped about 20%. So that is having real world impact, and that is immediate, and it may require changes or pivots to lender. It may require changes or pivots to strategy. So important to be across whatever you had in place prior to budget night may not look the same under the current setting. More broadly with clients, we're probably seeing two areas of conversation. One is around asset ownership. So to Tom's point, a lot of our Medicos clients operate businesses or hold investments through family trust structures. So considering the changes, clients are now looking to have those structures reviewed. There may be restructuring requirements there down the line with regards to funding attached to that as well. But to Tom's point, don't rush into it. The advice is, wait and see. Understand what the impact is of the proposed changes and what the options are going ahead. But certainly, just understand where that runs. We're also seeing a lot of interest in regards to SMSF borrowings. Clients are looking now more than ever at more tax-effective structures to hold their assets and investments. SMSF is still a safe haven here. In terms of the lending market, there are a number of options for our clients when it comes to this space. They are more concentrated. It's more focused in the non-bank space and specialist lender space. But I wouldn't be surprised if we see one or two of the major banks re-enter if demand continues to grow here. The other main area is just asset allocation. So real property has always been a big part or a cornerstone of doctors' wealth creation strategies, and in particular the established stock. While I don't think the budget outcome is going to fundamentally change this, I do think it's going to change the way they allocate their capital across these assets. We've already seen a lot of increased demand in terms of new builds, development opportunities, commercial property scenarios that we're running for clients. We're looking at clients looking at upgrading their principal residence more than stepping into their next investment, again, to avoid the clutches of CGT there. So I think that's a trend that we'll continue to see to grow for a lot of our Medico clients. Outside of the tax changes, it's just important that clients continue to take into account the other considerations that come with property, asset quality, cash flow resilience, and just long-term fundamental of portfolio development. So I'm sure Scott and his team will talk to that in a moment, but certainly tax is one piece of the puzzle. The last final point is probably just around the fact that uncertainty creates opportunity. For a lot of our medical professionals, they're deemed low-risk clients from a lending perspective. So they should take advantage of this, optimise what they have in place, negotiate with their current bank, and work with a lending advisor who has access to multiple options and can negotiate on their behalf.
Perfect. Great. So the lending message is pretty clear. Like, don't assume your borrowing capacity as it stands. There's still lots of options out there, and the fundamentals really matter. Perfect time to hand over to Scott. Let's talk about property. It's a major part of the budget and the conversation right now. So what's happening in your world?
Definitely. Thanks, Matt. I guess, in 20 years in the property industry, we've seen all sorts of changes. We've seen property markets, rise, drop, rise again. We've seen interest rates go up and down. We've seen different government budgets and tax changes come and go, and obviously lots of different regulatory changes as well. And I guess the point is it's guaranteed to be more and more of this in the future anyway. So for us, it always comes back to the big picture. Like, our clients are looking to grow their wealth and grow up substantially. And to do that, they need assets. As the guys have already alluded to, in times like this, it's not about panic. It's about talking to your advisors. It's about looking for the opportunities and to keep investing. And there are lots and lots of opportunities out there. As Jack sort of already alluded to, obviously new property is the way to go for residential. There is commercial, self-managed super fund, plenty of opportunities in that now, and more of that type of product coming to the market because of this. And of course, the own home. We deal with a lot of upgrading of homes, and it's sort of part of the plan that we work with clients. So that's a good opportunity too. What does the property market look like? One thing that seems to be for sure from everyone is that rents are going to increase. The supply crunch that this will create from investors either leaving the market or abstaining from the market is going to create real world issues too. And it's already a super, super tight rental market. The general sort of growth of the market is looking to slow, not to crash, but to slow. I think you're going to find that there's going to be sort of almost two-tiered markets a little bit with the established market and the new build market. Certainly people are going to push towards new builds from this, and that market up, which that too is extremely tight at the moment. Australia is a super undersupplied market when it comes to property. We need a lot more properties, particularly with the immigration coming through, and we're just not supplying it. In fact, I think the numbers from the budget itself is going to reduce the number coming out, not increase it. At this point in time, new builds have never been more important. Obviously, the budget's pushing towards new builds, which will help to add to supply. But new builds have always been a winner for us. A couple of the reasons we like it is generally new versus established. New gets more rent. people will always pay more for a newer property. There's more deductions, and obviously a lot more now with this budget, less maintenance costs, and all this leads to a cheaper to hold investment. And the cheaper it is to hold, that means the longer you can hold it and get through those ups and downs of the property market. And of course, it means you can get into the next property quicker too as you're growing your portfolio. So that's really important. And probably one of the most important things that we find too with new builds is that you can build in value from day one. From the buying a block of land and what you add to it, you can actually get some good equity day one with the right type of purchase. So I think to sort of summarise that, the gap between new and established has just got a whole lot wider. Most investors, typically when they get into trouble, it's because of cash flow. And so now is the time to really look at that cash flow. As far as the CGT changes and what to do with your current portfolio, I think as everyone's already said, don't panic, just hold. The initial plan still stays the same. You just might need to revisit that plan and potentially need another property to fill the gap that the CGT changes might make for you. All in all, though, I think there's plenty of opportunity. It's about just talking to your advisors and thinking it through.
Great. Thanks, Scott. So a couple of things in there really, really worth learning. It's about time. And this isn't about right now. This is about the next kind of big, long period of time that we can think through. And the message is kind of don't do nothing. You're just going to work within the environment that we're in and execute there. The new versus existing challenges is a big one too, right, as we continue to go down that path. So perfect on that one. Thank you very much. Wrapping that, let's move to broader wealth. And I'll pass it to Jo. What's happening in your world, Joanne?
Thanks, Matt. Look, I think it's been a great reminder that all financial strategies can carry legislative risk. So this is the risk that your strategy may continue to be good or not so good based on what the politicians do. So when we think about protecting our clients and our strategies and our advice from the legislation, it's about diversification. So it's about having cash and having shares and having property. If you like to pay tax, then stay on the sidelines. Your country really thanks you. However, if not, this is an opportunity to get engaged in your own wealth creation, to find a winning team that has a winning playbook. Speak, as many of the guys have already said, this is the time to speak to your trusted advisors to really review what you're trying to achieve. So where you are today and where you want to be later, and find out what are the levers that can be pulled in this new time. Understanding the impact of, I'm sure, the wonderful strategies that you already have in place, so all the great work that you've already done, the impact on your structures, the impact on your investments, and what that might mean going forward. I would say, lastly, echoing Matt, what many of the guys have already said, is that we have a lot of, we have time. So please don't rush out and sell assets, thinking that you want to get your money out now before what happens next. Make a really well-informed decision on what to do next.
Great, thank you. We spoke briefly before this, and I think you made a point that landed with me really well, which is that budgets do not build wealth, action does. And I think that kind of sums up really nicely how we're all talking here today, which is, yeah, there's lots of changes, there's lots of things happening, but the reality is sitting and waiting is probably not going to be the way we build wealth broadly now or in the property market or even with lenders as we go. So with that thought in mind that action matters, let's move to some practical next steps. I'm going to put you all on the spot. I want one thing that if you were a Medico right now that you want to walk away with. Tom, unfortunately, I'll start with you, and the rest of you get a bit more time. But Tom, give me the critical. What's the one thing I want to walk away with today based on what we've discussed?
Probably the walk away thing, Matt, the takeaway here is that these changes are probably going to affect most medicos. Whilst they may affect you, these are announcements that we're talking about from the government. We're yet to see this legislated. So don't go out and panic and panic sell. Do, however, talk to your advisors, your trusted advisors who are across these changes, because it's very important. There may be changes to the legislation as it goes through the Senate, for example. You want to be up to date. You want to know exactly how this is going to impact you over the journey. And we may be talking, regularly for the next couple of years before all of these changes are implemented.
Perfect. Thank you. Jack, over to you.
Yeah, look, I guess just get organised, get clear on your numbers. Sequencing in this environment becomes really important when you do things. So understanding why and what the alternatives are there. For a lot of clients in the lending space, they've dealt just historically through their incumbent bank. So I guess I'd ask them to take the blinkers off, understand there's options outside of that. And there's a lot of opportunity for doctors to leverage their standing as a low risk customer in this uncertain market.
Perfect. Thank you. Scott? We can't hear you, Scott. You're on mute.
Sorry. I think from the property side, the type of property that you pick has never been more important. There's a lot of opportunity out there, but take advice. As Joe said before, take action still. Don't sit on the sidelines. There's still plenty of opportunity.
Great. Good stuff. Perfect. Hand over to Joe to close us out.
Gosh, thank you. I'm glad that no one else has said it yet, so maybe this is meant for me, but please don't be distracted by what's in the future. Today is the 1st of June, and we have 4 weeks in which to change your tax outcome today, now. So for all of our Medico clients in private practice, for clients splitting their time between public and private, for your spouses, for yourself, let's make sure we're having a conversation about super contributions, so that it's a slow race. If you don't do it today, you can't actually do it later. Thanks, Matt.
Bringing us back to the 30th of June deadline that looms. I love it. What a way to close out. Well, thanks very much, everyone, for your time and your input. We will obviously link out contacts as we publish this further, so you can reach out to anyone on the call. And we hope this was valuable. Thanks very much. Thanks, everyone. And we'll chat soon.
Thanks, everyone. Cheers.
Cheers.
Ciao.
Thank you.